Hey everyone, and welcome back to the channel. Today we're diving deep into a book that has genuinely changed how I think about finances. Not just the numbers, but the messy, fascinating human element behind them. We're talking about The Psychology of Money by Morgan Housel. This isn't your typical dry finance book filled with complex jargon and impenetrable graphs. Instead, Housel takes us on a journey through stories and observations, revealing that understanding our own behaviors, biases, and emotions is far more crucial to financial success than knowing the latest market trends or intricate investment strategies. He argues that doing well with money has less to do with how smart you are and more to do with how you behave. And let's be honest, human behavior, especially when money is involved, can be pretty irrational, unpredictable, and sometimes downright illogical. Over the next few sections, we're going to break down some of the most powerful insights from this book, exploring how our personal histories, our unique perspectives, and the surprising power of compound interest all play a role in our financial journeys. It's a conversation about wealth, yes, but more profoundly, it's about happiness, risk, and what truly matters to us. So, let's jump right in and uncover some of these profound truths together. The first core idea Housel presents is simply that no one is crazy. When it comes to money, everyone has a wildly different personal history, a unique set of experiences that shapes their financial outlook and the risks they're willing to take. Someone who grew up in poverty, for instance, will likely view debt, saving, and investing through a fundamentally different lens than someone who grew up with generational wealth. What seems completely irrational to you, like someone taking on a huge loan for a risky venture, or another person hoarding cash, is perfectly logical to them, based on the economic lessons they learned in their formative years. Think about the market crashes or economic booms that happened when you were a child or young adult. Those events imprinted a lasting, subconscious belief about how the world and money works. We need to acknowledge this locus of control and realize that judging someone else's financial decisions based solely on our own experience is a fool's errand. This perspective forces us to drop the arrogance and understand that a rational financial decision is actually just one that helps us sleep at night, not one that is universally mathematically optimal. This empathy is key because it shifts the focus from judging others to understanding our own behavioral baggage. And speaking of sleeping well, that brings us to the monumental power of compounding. This is the engine of wealth, yet it's often the hardest concept to grasp intuitively because our brains aren't wired for exponential growth. Housel uses the famous example of Warren Buffett. His success isn't primarily because he's the world's best investor, but because he's been a good investor for 75 years. His skill is evident, yes, but his secret is time. Most of his net worth was accumulated after his mid-50s, purely due to the magic of compounding interest and reinvested returns snowballing over decades. It's a reminder that truly great results are rarely achieved through a single spectacular event, but by consistently doing the same simple things and giving them enough time to grow. Don't chase the highest returns or the quick wins. Instead, focus on being consistently solid and letting the years do the heavy lifting. This insight shifts the focus from seeking high-risk, high-reward strategies to prioritizing longevity and endurance in your financial plan. The greatest returns are often hidden in plain sight, patiently waiting in the long game. This concept of longevity brings us to another crucial point: the difference between being rich and being wealthy. Housel makes a sharp distinction here. Being rich is often an ego-driven display, buying expensive cars, big houses, and luxury items. It's about visible, immediate consumption, which is really just a snapshot of a person's current income or assets, not necessarily their future stability. Wealth, on the other hand, is unspent income. It's the financial assets that are quietly building behind the scenes, offering you freedom, flexibility, and control over your time. It's the optionality to quit a bad job, take a risk on a new venture, or simply wait out a market downturn without panic. You don't see wealth because its value lies in its potential and its ability to grant independence, not its visibility. True wealth isn't about status, it's about the ability to purchase time and security. The rich person is the one who spends to show off, but the wealthy person is the one who saves and invests to buy future peace of mind. This subtle psychological shift from consumption to preservation is arguably the most powerful lever in personal finance. The fifth critical lesson is recognizing the seductive danger of the man in the car paradox. Housel observes that when people buy expensive things, that fancy sports car, for example, they often believe that others will look at them and think, wow, that person is cool and successful. But here's the paradox. When we see someone driving a beautiful car, we rarely think about the driver. Instead, we think, if I had that car, I would be cool and successful. The reality is that people are focused on themselves, not you. The expensive item you bought to signal your success is actually a distraction. It signals your spending, not your net worth. And here's the kicker. The money used to buy that object is money that is now not compounding, pushing your goal of true wealth further away. This paradox is a powerful reminder that if you want respect and admiration, focus less on material possessions and more on the kind of person you are and the financial freedom you cultivate. True respect comes from independence, not accessories. This ties directly into the crucial concept of saving money, which Housel argues is the single biggest factor you control. Financial independence isn't about having a massive income. It's about having a high savings rate. Your savings rate is more important than your investment returns because the rate of return is outside your control, but how much you save is entirely up to you. Moreover, saving doesn't require a specific reason, like saving for a house or a car. Housel calls this saving for nothing. This nothing is actually the most valuable thing you can save for: flexibility and optionality. It's the ability to change your mind, to wait for better opportunities, or simply to survive a crisis without being forced into making terrible, panicked decisions. Money saved for nothing is your ultimate insurance policy against life's inevitable curveballs. It buys you time, reduces stress, and increases your control over your own destiny, which is a far greater return than any stock can offer. This freedom brings us to the importance of recognizing the value of time horizon. When you have that savings cushion, you can afford to think longer term than other investors. Housel points out that most market volatility and the resulting panic are driven by short-term thinkers, people who can't afford to wait a year or two for the market to recover. As a long-term investor, your biggest edge is your ability to ignore the daily noise and simply stay put. Volatility stops being a crisis and starts being a temporary sales event. If you have a 30-year horizon, what happens in the next 6 months is financially meaningless, but psychologically, it can be devastating to those without patience. This is why having enough cash to cover a few years of expenses during a downturn is so vital. It prevents you from becoming a forced seller at the worst possible time. The shorter someone else's time horizon is, the greater your opportunity is to remain calm, disciplined, and ultimately outperform them. Patience is an active financial strategy, not a passive trait. It's important to acknowledge that not all risks are created equal, and this leads to the distinction between getting wealthy and staying wealthy. Getting wealthy often requires taking risks, being optimistic about the future, and seizing opportunities. However, staying wealthy requires the exact opposite: humility and fear. The fear that what you've accumulated can be taken away quickly. Housel points out that many people who successfully make a fortune lose it because they keep behaving as if they are still trying to get rich. They take the same high-stakes risks that got them there, not understanding that the goal has shifted from accumulation to preservation. The strategy for preservation is survival. It's about making sure you can endure the inevitable setbacks, recessions, and personal tragedies that life throws at everyone. You need a margin of safety, a buffer that is large enough to absorb the shock of reality. Because the greatest asset in life is simply being able to stay in the game. It's also vital to grasp the profound difference between rational and reasonable. Mathematically, the most rational choice might be taking on maximum leverage or investing every spare penny in the highest growth, highest risk stocks. But Housel argues that what is rational on a spreadsheet is often unreasonable for a human being who has to live with the psychological consequences of that risk. If the optimal strategy causes you so much stress and anxiety that you abandon it at the first sign of a downturn, it was never the optimal strategy for you. A reasonable financial decision is when you can actually stick with long-term, one that helps you sleep at night, even if it means sacrificing a few percentage points of theoretical return. Consistency and endurance trump maximum optimization every single time. It's better to be reasonably successful and consistently happy than mathematically perfect and psychologically ruined. This focus on the human side is what makes the book so powerful. The greatest tool for staying in the game is the concept of room for error, also known as a margin of safety. Housel stresses that the biggest financial risk isn't necessarily having a bad investment or missing out on a huge gain. It's getting wiped out entirely and being forced to abandon your long-term plan. This is where the difference between a mathematically perfect plan and a human survivable plan becomes painfully clear. A spreadsheet might suggest you can sustain a 50% market drop, but a margin of safety acknowledges that life is messy. You might lose your job at the exact same moment the market falls, or your roof might leak, creating a double whammy. You need a buffer, extra cash, a lower than optimal stock allocation, or a mortgage payment smaller than what you could technically handle. This buffer ensures that when the unknown unknowns inevitably hit, you don't have to sell your assets at a loss simply to cover a short-term crisis. The purpose of this safety net isn't to maximize returns by a few percentage points. It's to guarantee endurance. If you survive long enough and remain invested, compounding guarantees the returns will eventually follow. Housel dedicates an entire section to the concept of luck and risk, arguing that they are two sides of the same coin and are often the unseen forces driving extreme outcomes. The world is simply too complex to attribute 100% of success or failure to individual effort or individual decisions. Extreme success is often a result of being in the right place at the right time, a form of luck, just as catastrophic failure is often the result of an unavoidable risk. His key takeaway here is to be cautious about who you admire and who you dismiss. When you study a massive financial success story, try to identify the role luck played, and when you see a colossal failure, try to understand the risks that were outside of that person's control. This helps you avoid the trap of replicating a successful individual's specific, often lucky, actions. Instead, focus on broad, repeatable patterns of behavior and strategy. It's about recognizing that what happens in the tails of the distribution, the wildly unexpected events, often drives the majority of results. One of the most dangerous psychological forces Housel identifies is the pressure to keep the goalpost from moving. We have a natural tendency towards social comparison, constantly measuring ourselves against others, specifically people in a higher financial bracket than us. This creates a relentless cycle. You achieve a certain level of income or net worth, and instead of feeling satisfied, you immediately reset your expectations higher, looking at the person who has just a bit more. This is the recipe for perpetual unhappiness and, more dangerously, an incentive to take increasingly reckless risks. Housel's antidote is the simple yet profound concept of enough. Knowing when you have enough is not about being conservative.
It's about recognizing that the opposite, an insatiable appetite for more, will eventually push you to the point of regret, risking what you have and need for what you don't have and don't need. The true genius lies in finding satisfaction and building a financial ceiling that prevents you from crossing a line into foolishness.
Housel brilliantly discusses that nothing is free, especially in investing. While most people understand transaction fees or management fees, the real psychological price of investing is far more insidious. He calls the price of successful market returns volatility, fear, doubt, and uncertainty. These are not fees listed on a statement. They are the required payments you make in emotional currency to earn long-term gains. If you want a 10% annual return from the stock market over 30 years, the price you pay is the experience of watching your portfolio value drop 20% or 30% several times along the way and enduring the agonizing doubt that you've made a terrible mistake. Investors who try to avoid paying this price by timing the market, panicking, or selling during a crash are essentially trying to get something for nothing, which is impossible. You must acknowledge the emotional discomfort as a cost, not a fine or a penalty. If you are willing to pay the price of admission, which is enduring the periodic terror, the payoff is almost certain. You need to understand the concept of tail events because they drive everything. Housel explains that in many financial and business endeavors, a small number of events or outcomes account for the vast majority of the results. Think of venture capital. A fund might invest in 50 companies, but 40 of them fail, 5 return their capital, 4 do pretty well, and one single tail investment, like an early Google or Amazon, produces 99% of the fund's total return. The same principle applies to your personal investments. Your success isn't determined by your average stock or your average decision. It's determined by the few investments that go spectacularly well and are allowed to compound for a very long time. This realization is freeing because it means you can be wrong half the time and still be immensely successful. The key, then, is to ensure your inevitable failures are small and non-fatal while allowing your big winners to run, which reinforces the need for that room for error to survive the many setbacks.
A major recurring theme is how our past experiences heavily dictate our present financial beliefs. Housel points out that your view of risk, stock market volatility, and debt is profoundly influenced by the economic environment you were raised in, particularly during your teens and 20s. Someone who entered the workforce during a booming economy might view the stock market as a guaranteed path to riches, while someone who started during the 2008 financial crisis will likely be much more conservative and perhaps overly skeptical of institutions. The market data is the same for everyone, but the personal psychological data we carry is completely unique. This makes it impossible to define a truly optimal investment strategy that works for all people because what works on a spreadsheet can clash violently with our deeply ingrained emotional programming. Recognizing that your personal history creates financial blind spots is the first step towards overcoming them and developing a strategy that aligns with your specific emotional tolerance for risk. Another powerful observation is the highest dividend money pays: control over your time. Housel emphasizes that the true practical value of wealth isn't the ability to buy luxurious goods, it's the ability to wake up in the morning and say, I can do whatever I want today. Money used to increase your flexibility, your choices, and your autonomy provides a far greater psychological return than money spent on visible status items. It's the ability to choose your job, your commute, your hours, and your colleagues, or to simply walk away from a toxic situation. This kind of freedom is the ultimate non-monetary return on investment. If you view saving and investing primarily as a means to purchase time and independence, you are less likely to fall into the trap of social comparison and endless material consumption. The ultimate metric of success isn't your net worth number, but the amount of control you have over your daily life. We need to talk about the inevitability of change. Housel warns against making extremely long-term financial plans based on your current desires and personality because people are terrible at forecasting their future selves. The person who is happy to live frugally in their 20s to save aggressively might become a family person in their 30s who wants a bigger house and more experiences. The high-powered professional who loves 80-hour work weeks now might burn out and desperately crave an early retirement later. Financial planning must account for this emotional and aspirational evolution. The most successful long-term plans, therefore, are not rigid and optimized for one outcome, but flexible and built with a margin of safety that allows you to change your mind without financial ruin. You should aim for a plan that is moderate and survivable, recognizing that what you prioritize today will almost certainly be different 10 years from now. A key lesson is the danger of financial bubbles and understanding the story we tell ourselves during them. Housel argues that bubbles don't just happen because everyone's greedy. They happen because investors collectively believe a plausible yet incomplete story. A rational core idea like the internet will change the world or real estate is a safe investment gets mixed with a crowd of short-term speculators, and the story gets pushed to irrational extremes. The problem isn't the original idea, it's that different people are playing different games with different time horizons. A long-term investor might be confident in a company's 20-year potential, but a day trader is betting on the stock's price next week. When these two groups mix, the resulting volatility and rapid price appreciation can be misinterpreted as confirmation of the long-term story, pulling in even more emotional investors and creating a manic cycle that inevitably bursts. This brings us to the importance of recognizing whose game you are playing. Housel emphasizes the risk of taking your financial cues from people whose goals and time horizons are completely different from yours. If you're a long-term investor saving for retirement, watching the news commentary about a stock's short-term price movement or following a day trader's quick profits is disastrous. They are playing a speed game while you are running a marathon. Their volatility is a necessity. Your volatility is a threat to your ability to stay in the game. It's crucial to clearly define your personal time horizon, your goals, and your risk tolerance, and then consciously filter out all information and advice that comes from people playing a different game. Ignoring the noise from short-term players is perhaps the most important discipline a long-term wealth builder can have. Housel touches on the concept of optimism and paranoia, which should be balanced. Successful long-term investing requires a broad, fundamental optimism, a belief that over decades the world will create more wealth, solve more problems, and the economy will generally progress. Without this optimism, you wouldn't invest at all. However, this optimism must be paired with paranoia regarding the specific investments and the short-term future. You must be paranoid enough to know that bad things will happen. Recessions, company failures, pandemics, and personal setbacks. This paranoia is what fuels your margin of safety, your cash reserves, and your diversification. It's a barbell personality, optimistic about the future of the world, but deeply cautious and conservative about your personal ability to survive the inevitable chaos of getting there. The book emphasizes that financial history is a poor, though useful, guide to the future. History can teach us about how people behave under stress. Greed, fear, and panic are timeless. But history cannot tell us what will happen next because the specific risks and causes of the next crisis will always be different from the last. No one predicted the exact nature of the 2008 crash or the COVID-19 pandemic. Housel cautions against relying too heavily on historical data to predict market returns or specific events. Because the biggest, most impactful events, the tail events, are precisely the ones that have never happened before. Use history to understand the psychology of crises, but use your imagination to prepare for risks that have no precedent. We need to talk about the distinction between frugality and misery. Housel makes the point that being frugal doesn't mean depriving yourself to the point of unhappiness. It means maintaining a mindset where you resist the urge to increase your spending simply because your income has increased. This concept is often called lifestyle inflation, and it's the primary enemy of wealth creation. If your spending grows alongside your income, your savings rate, the true driver of wealth, never improves. Frugality, in Housel's view, is simply prioritizing independence and future flexibility over present consumption. The feeling of financial control and reduced anxiety is the psychological trade-off that makes frugality not just bearable, but actually rewarding. This brings us back to the most critical point, the importance of survival. Above all else, your financial strategy must be unbreakable. You should design your portfolio and your lifestyle to withstand a wide range of outcomes and stresses without being wiped out or forced to sell at the bottom. This means avoiding ruinous risk at all costs, any single risk that could permanently take you out of the game, regardless of the potential reward. The ability to simply stick around, to endure the inevitable market crashes and recessions, is the key to unlocking the full potential of compounding. If you survive, the math works in your favor. If you don't, the greatest returns in the world mean nothing. Survival is the single most important variable in the long game of wealth. Finally, Housel concludes by reminding us that the most valuable part of financial success is simply being kind and helpful to others. He uses the powerful example of a wealthy, successful person who spent a fortune trying to impress people who didn't care, only to find that the highest forms of respect and admiration come not from the objects you own, but from the person you are. Your humility, kindness, and empathy. The irony is that the pursuit of money often requires sacrificing these very qualities, yet they are what ultimately lead to a fulfilling and well-respected life. Don't risk things that are invaluable, like your reputation, freedom, family, and friends, for things that are merely a price tag. Wealth is a tool for happiness, but it cannot buy character, which is the most valuable asset of all. So, what's the big picture? Housel's genius is in showing us that finance isn't just about math. It's a social science, it's a soft skill where behavior trumps intelligence. The most important lessons aren't found in a complex formula, but in simple, timeless truths like the magic of compounding, the necessity of a large margin of safety, the freedom that comes from a high savings rate, and the profound wisdom of knowing when you have enough. It's about being reasonable, not just rational, and playing the longest game possible.